Okay, in this video, we're going to start to look at some of the aggregate demand and aggregate supply side factors influencing growth and living standards. So in the first video, we're really going to focus on what the difference is between aggregate demand and aggregate supply and how they differ in terms of the impact they have on the economy and how they allow the economy to grow. So a country's rate of economic growth can change as a result of two major factors. They can either be aggregate demand factors, which are basically factors, in really simple terms, factors that impact spending, factors that impact the demand for Australian-made goods and services, or aggregate supply factors, which essentially affect our total supply potential and our ability to produce goods and services. So aggregate demand factors, I'll start with the right, affect total spending on Australian-made goods and services. And essentially what they're looking at is they're looking at to what extent we're going to use our productive capacity. So if there's lots of demand, we're going to get closer to our productive capacity because we'll hire more resources and use more of our available resources. So basically, it's things that influence demand for Australian goods and services. So it might be consumer and business confidence, interest rates, the exchange rate, population, tax rates, and we'll explore all of these in later videos. In terms of aggregate supply side factors, these are factors, and the key word here is that factors that impact our potential to supply. They affect changes in either the quantity or quality of resources. They're the key words. They improve the quantity or quality of resources and influence our supply potential. A lot of these factors relate to the production costs associated with goods and services and the incentive to produce goods and services. We'll also look at certain government policies that influence aggregate supply as well. So the key difference, factors boosting aggregate demand will encourage firms to use more of their resources and get closer to our productive capacity, whereas factors boosting supply actually increase the quantity or quality of those productive resources and improve our overall supply potential. So these ones we'll look at in later videos, but basically these factors impact demand or the overall demand for Australian goods and services, where the factors on the right-hand side improve or change our overall ability to supply products. So looking at demand side factors first, in the short term, Australia's economic growth rates can change quite suddenly, and that can be as a result of anything that influences aggregate demand. And when we're looking at aggregate demand, we're looking at factors that impact consumption, so the spending of households, businesses, which is investment spending, and government spending, or anything that impacts exports as well. Okay, so shifts in aggregate demand, basically what that means is our real GDP occurs where the aggregate demand, aggregate supply curves intersect. And real GDP can be measured by total production, income, or expenditure. It can be enhanced by either increasing aggregate demand or influencing aggregate supply in the long term. If aggregate demand shifts right, we get stronger growth at higher prices. If aggregate supply shifts right, then we get higher growth at lower prices. So basically, the key thing here is with aggregate demand side factors is we're looking at increased expenditure, which should then flow on to increased production and then through increased employment throughout the economy. So we're focusing on flow 3 first, where we boost the demand equation. Then that leads to more production, which flows on to more demand for resources and higher incomes throughout the economy. A shift in aggregate demand generally leads to an expansion in supply because producers generally produce more, assuming they can, to meet that extra demand. Okay, so hypothetically, assume aggregate demand was originally at $1,000 billion a year. Then businesses would try and produce around $1,000 of goods and services. In order to do this, firms will purchase $1,000 billion worth of resources, so land, labour, and capital, and they'll be paid about $1,000 billion in income. If we increase any of those flows, it should flow on to increasing the other flows in turn. Okay, so basically, if we talk about increased spending, so if there's increased spending on food, clothes, holidays, health, etc., then that will lead to an increase in injections relative to leakages and help to boost the economy and increase economic growth. So, for example, if there's a sudden increase in aggregate demand, so if any of these factors occur, that leads to an increase in C, I, G, or X. Aggregate demand rises, so what happens is firms experience increased shortages start to emerge, and they increase their production, assuming we're not at our productive capacity. They therefore increase GDP, and that leads to increased growth throughout the economy. In order to increase production, they hire more resources, and that flows on to increased incomes again and flows throughout the circular flow. In terms of the opposite, if there's weaker demand side conditions, we see a decrease in C, I, G, or X. Firms experience surpluses of goods and services or stock. Therefore, they lower production. Because they lower production, they need less resources. That leads to less incomes, and it flows through the economy in the opposite direction. Okay. So when reduced demand, weaker demand side conditions, a fall in one of the components, which then leads to a decrease in stock levels, which leads to decreased production, which then leads to decreased demand for resources, which leads to decreased incomes. So we're talking about spending in the economy here. Okay, so some key aggregate demand factors. Aggregate demand represents the total value of all spending each year on Australian-made goods and services by households, businesses, and the government. It's influenced by consumption spending, private investment spending, government spending, and exports. Essentially, increases in aggregate demand or decreases in aggregate demand determine what extent of a country's productive capacity they're going to use, as opposed to aggregate supply side factors, which actually shift the nation's productive capacity. Okay, so the key things, and we'll talk about these again a bit later in more detail, but we're talking about things that impact household incomes, optimism or pessimism, so consumer confidence or business confidence, tax rates can impact demand, interest rates, the value of the dollar, cost of buying exports and imports, economic conditions overseas, and our population growth are some of the key factors impacting demand. Just one thing to finish off with, when you're talking about an increase in aggregate demand, you don't want to say an increase in aggregate demand also leads to a shift in aggregate supply. So what essentially happens is that an increase in aggregate demand leads to an expansion in supply because the increase in demand leads to shortages, so businesses supply more to meet the demand. It is wrong to say the supply curve shifts. The supply curve will only shift when firms are more willing or able to supply. An increase in aggregate demand only leads to an expansion in aggregate supply. It doesn't lead to a shift in aggregate supply. There's no change in the quantity or quality of resources. Supply would generally only shift if there's changes in production costs, participation, or productivity, or availability of resources. We'll talk about aggregate supply factors in the next video.